The Moving Average Convergence Divergence, or MACD, is a favorite tool for many traders. It's popular because, well, it's both simple and effective. The indicator helps traders understand the direction and strength of a market trend. It was created by Gerald Appel in the late 1970s. Since then, it has become a standard feature on almost every trading platform. Traders use it to spot potential buy and sell signals in stocks, Forex, and other financial markets. Its visual nature makes it easy to interpret, which is great for both new and experienced traders. It provides a clear picture of market momentum. The core job of the MACD is to show the relationship between two moving averages of a security's price. By comparing a faster moving average with a slower one, the indicator reveals changes in momentum. When momentum is increasing, it might signal the start of an uptrend. When momentum is decreasing, it could mean a downtrend is beginning. This ability to measure momentum is why the MACD is so valuable. It helps traders get a sense of the underlying force driving the price action. This insight allows traders to make more informed decisions rather than just guessing. The MACD is considered a trend-following momentum indicator. This means it works best when a market is moving in a clear direction, either up or down. In markets that are moving sideways or are very choppy, the MACD can give false signals. Understanding this limitation is key to using the tool successfully. Traders who know when to trust the MACD and when to be cautious have a significant advantage. It's not a magic crystal ball, but it is a powerful instrument when used correctly. Its reliability in trending conditions has cemented its place in technical analysis. One of the main reasons for its widespread use is its versatility. The MACD can be applied to any time frame, from short-term day trading charts to long-term weekly charts. This flexibility allows different types of traders to adapt it to their specific strategies and goals. Whether you're looking for quick profits or long-term investments, the MACD can offer valuable insights. It helps identify potential entry and exit points with a level of clarity that few other indicators can match. This universal appeal is a testament to its robust design and enduring relevance in the dynamic world of trading. To master the MACD, you must first understand its three main components. The first is the MACD line itself. This is the heart of the indicator. It's calculated by subtracting the 26-period exponential moving average, or EMA, from the 12-period EMA. The result is a single line that oscillates above and below a central zero line. The MACD line is the fastest moving part of the indicator. It's designed to react quickly to changes in the market's price. When this line is moving up, it suggests that bullish momentum is increasing. When it's moving down, it suggests bearish momentum is on the rise. The second component is the signal line. This is a 9-period EMA of the MACD line. Because it's an average of the MACD line, it moves more slowly. Its purpose is to smooth out the MACD line's movements and provide clearer trading signals. The interaction between the fast MACD line and the slow signal line is what generates many of the most common trading strategies. Traders watch these two lines very closely. The relationship between them helps to confirm changes in momentum and can signal when it might be a good time to enter or exit a trade. The third element is the MACD histogram. The histogram visually represents the difference between the MACD line and the signal line. It appears as a series of vertical bars that fluctuate above and below a zero line. When the MACD line is above the signal line, the histogram bars are positive and appear above the zero line. When the MACD line is below the signal line, the histogram bars are negative. The height of the bars indicates how far apart the two lines are. Growing bars suggest strengthening momentum, while shrinking bars suggest weakening momentum. Each of these three parts works together to provide a complete picture of market momentum. The MACD line gives the initial momentum reading. The signal line acts as a filter to confirm the signals. The histogram provides a quick visual guide to the strength and direction of that momentum. By learning to read all three components in unison, a trader can gain a much deeper understanding of the market's behavior. This comprehensive view is what makes the MACD such a powerful tool for technical analysis, helping traders to anticipate price movements with greater confidence and precision. One of the most common ways to use the MACD is through line crossovers. A bullish crossover happens when the faster MACD line crosses above the slower signal line. This is often interpreted as a buy signal, suggesting that momentum is shifting to the upside. Conversely, a bearish crossover occurs when the MACD line crosses below the signal line. This is typically seen as a sell signal, indicating that momentum is turning to the downside. Traders often wait for the crossover to be confirmed by the price action on the chart before entering a position. This simple strategy is popular for its clarity. Another popular strategy is the zero-line crossover. This occurs when the MACD line crosses the central zero line on the indicator. When the MACD line moves from below the zero line to above it, it signals that the 12-period EMA has crossed above the 26-period EMA. This is a strong indication of a potential new uptrend. On the other hand, when the MACD line crosses from above the zero line to below it, it suggests a new downtrend may be starting. These signals are generally considered to be slower but more reliable than the signal line crossovers. Divergence is a more advanced but very powerful MACD signal. It occurs when the price of an asset is moving in the opposite direction of the MACD indicator. For example, bullish divergence happens when the price makes a new lower low, but the MACD makes a higher low. This suggests that the downward momentum is weakening and a price reversal to the upside could be coming. Bearish divergence is the opposite. The price makes a higher high, but the MACD makes a lower high. This signals that bullish momentum is fading and a downward reversal might be near. Finally, traders can use the histogram for signals. The histogram measures the distance between the MACD line and the signal line. When the histogram bars stop getting taller and start getting shorter, it shows that the momentum of the current trend is slowing down. For example, in an uptrend, if the histogram bars start to shrink toward the zero line, it could be an early warning that the trend is losing steam. This can be used to take profits or tighten stop losses. This strategy allows traders to get ahead of the crossovers, but it also carries more risk, as it is an earlier, less confirmed signal. While the MACD is a strong indicator on its own, it becomes even more powerful when combined with other tools. For instance, pairing the MACD with the Relative Strength Index, or RSI, can help confirm signals. If the MACD gives a bullish crossover while the RSI is moving out of oversold territory, the buy signal is much stronger. Adding volume analysis can also be very effective. A MACD buy signal accompanied by high trading volume adds a layer of confirmation that there is real conviction behind the move. Using multiple indicators helps filter out false signals and increases the probability of a successful trade. The standard MACD settings are 12, 26, and 9. These are suitable for medium-term swing trading. However, these settings can be adjusted to fit different trading styles. A short-term day trader might use faster settings, such as 5, 35, and 5, to get more responsive signals for quick moves. A long-term investor might prefer slower settings like 24, 52, and 18 to focus on major trend changes on weekly or monthly charts. The key is to find the settings that align with your trading time frame and strategy. Experimenting with different parameters is essential to optimize the indicator for your needs. It's crucial to remember that the MACD performs best in trending markets. When a stock or currency is moving in a clear uptrend or downtrend, the MACD provides reliable signals about momentum. In sideways or ranging markets, the MACD will frequently generate false crossovers, leading to confusion and potential losses. In such choppy conditions, it's often better to use range-bound indicators like Bollinger Bands or oscillators. Recognizing the market environment is a critical skill for any trader. Knowing when to use the MACD and when to sit on the sidelines is just as important as reading its signals correctly. No trading strategy is complete without proper risk management. Always use a stop-loss order to protect your capital in case a trade moves against you. Before risking real money, it is vital to backtest your MACD strategy on historical data. This helps you understand how it would have performed in the past and builds confidence in its effectiveness. The ultimate goal is to find a MACD strategy that fits your personal risk tolerance and trading style. Success in trading comes from a combination of a solid strategy, disciplined execution, and rigorous risk control. The MACD is just one tool, and its effective use depends on the trader wielding it.